Good morning, afternoon, professors and fellow students. We are Ruyu Yang and Dai Yan. Today our presentation topic is Dynamic Multi-Asset Allocation and Microservices-Based War Room System based on PPO and SMC. In simple terms, we quantify the smart money concept, which is commonly used in trading practice to interpret institutional capital movements, and feed it into proximal policy optimization, a reinforcement learning algorithm. This enables the model to learn how to dynamically adjust asset allocation across different market conditions. At the same time, we implement the entire system using a microservices architecture and build it into a real-time war room interface, allowing every AI decision to be visible and verifiable. The backtesting period covers 2018 to 2026. The presentation is divided into 5 parts, following a standard research structure. The first part is the introduction, which explains the introduction motivation, the limitations of traditional methods, and the positioning of our proposed solution. The second part is related work, where we review 4 major areas of literature and identify the existing research gap. The third part is the proposed scheme, which presents the detailed system design, including the overall architecture, sector allocation, and the specifications of PPO and SMC. The fourth part is simulation, where we present the experimental setup and comprehensive performance evaluation. Finally, the fifth part is the conclusion, which summarizes our contributions and discusses future work. First, we begin with the first section, Introduction. We first discuss the research motivation. In recent years, with the rapid development of generative AI and high-performance computing, quantitative trading has evolved from a tool used by only a few institutions into a core capability in capital markets. From a data perspective, the global algorithmic trading market is estimated to reach approximately $2.72 billion in 2026, while the total scale of quantitative strategies managed by major investment banks has reached around $850 billion, more than double the level 5 years ago. At the same time, representative AI-related stocks such as NVIDIA, AMD, Micron, and TSMC have all reached record highs in 2026. This implies that the problem of multi-asset allocation is no longer simply about the traditional balance between stocks and bonds. Instead, it is about how to dynamically adjust exposure among high growth, high volatility, and high uncertainty. However, traditional asset allocation methods have clear limitations when facing this type of structural change. First, models such as the Markowitz mean variance model assume stable return distributions and moderate correlations. Once the market enters a regime shift characterized by high volatility or synchronized cross-asset repricing, such models cannot respond quickly enough to hedge risk. Second, common technical indicators such as RSI and MACD suffer from obvious lagging effects. In many cases, they only generate signals after the major price movement has already occurred. Third, the hedging effectiveness of gold and long-term bonds has become increasingly conditional. The static logic of buy bonds when stocks fall is no longer sufficient. The figure on the right provides concrete evidence. In historical backtesting, the traditional Markowitz strategy achieves an annualized return of approximately 12.3%. However, its maximum drawdown reaches as high as 28.5%, and its Sharpe ratio is only 0.78, exposing significant tail risk during extreme market events. Based on these challenges, our proposed solution consists of 3 essential pillars. The first pillar is PPO. We use proximal policy optimization as the agent for dynamic asset allocation, and the reward function includes penalties for drawdown and transaction costs. The second pillar is SMC. We quantify structural signals from the smart money concept, including BOS, CHOCH, FVG, and OB, into observable states. This allows the model to learn more forward-looking risk transitions from the distribution of institutional liquidity. The third pillar is the war room system. We use a microservices architecture built with React and Spring Boot to present decisions in real time, thereby addressing the black box criticism often associated with reinforcement learning. We divide the asset pool into 3 sectors: offensive assets, defensive assets, and cash. Next, we move on to the second section, related work. Our literature foundation is built on 4 dimensions. First, traditional asset allocation is grounded in Markowitz's 1952 mean variance model. However, backtesting shows that although it achieves an annualized return of approximately 12.3%, its maximum drawdown reaches as high as 28.5%, with a Sharpe ratio of only 0.78. A 2025 report by PIMCO also points out that 60/40 portfolios and risk parity strategies are no longer as effective in controlling risk under the current interest rate environment. Second, in the field of deep reinforcement learning, PPO has become a mainstream approach due to its stable policy updates and high sample efficiency. Empirical evidence published by Hans publishers in 2024 shows that when short selling is allowed, PPO can achieve an annualized return of 22.18%, a Sharpe ratio of 1.10, and a maximum drawdown of negative 17.21%, outperforming the equal weight strategy. In Taiwan, master's theses from National Central University and National Chengchi University have also incorporated maximum drawdown into the reward function. Third, SMC reconstructs institutional footprints through BOS, CHOCH, order blocks, and fair value gaps. Hantech points out that lagging indicators such as RSI and MACD cause around 90% of retail traders to become sources of liquidity hunted by the market. Fourth, in terms of microservices-based war room systems, LinkedIn's distributed trading platform uses Spring Boot and Kafka for decoupling, while real-time front-end visualization is used to reduce the black box nature of the system. On this slide, I would like to let the data speak for itself by placing the empirical performance of traditional allocation methods and deep reinforcement learning methods side by side. The table on the left lists Markowitz, LSTM, Transformer, DDPG, and PPO from top to bottom. We can observe a very clear trend. The annualized return increases from 12.3% onward. The Sharpe ratio improves from 0.78 to 1.10 and further to 1.47, while the maximum drawdown decreases from 28.5% to around 17%. In other words, reinforcement learning does not simply pursue higher returns by taking on higher risk. Instead, it improves risk-adjusted returns while reducing drawdown. On the right, we highlight 2 additional points. A 2026 archive study shows that the Sharpe ratio of DRL is 1.17, which is 1.85 times higher than the 0.68 achieved by traditional MVO. The overall drawdown is also improved by approximately 11 percentage points. To be transparent, these figures come from different studies, with different backtesting periods and asset pools. Therefore, this slide is intended only as an order of magnitude comparison. However, the conclusion is consistent. Although existing studies are effective, their observation states mostly remain limited to prices and technical indicators. By integrating the 4 dimensions discussed earlier with the empirical data, this positioning matrix best illustrates where our study stands. The horizontal axis represents 4 key capabilities: dynamic regime adaptation, institutional liquidity signals, risk-oriented reward design, and decision transparency. As shown in the matrix, Markowitz lacks almost all 4 capabilities. Equal weight and risk parity strategies are transparent, but they do not dynamically adapt to changing market regimes. Traditional PPO can adapt dynamically and incorporate risk-based rewards, but it does not observe institutional liquidity and lacks transparency. Subjective SMC trading can observe liquidity, but it does not have a systematic reward function or decision transparency. In other words, each existing method only covers part of the problem. Our study, shown in the bottom row, is the first to quantify FVG distance, OB touch, BOS, and CHOCH into continuous state vectors and integrate them into PPO observations. We then use the war room system to provide decision transparency. By doing so, our framework fills all 4 dimensions at the same time. This is the research gap we address and the main contribution of our work. The third section is the proposed scheme, which presents the detailed design of our system. Let us first look at the overall architecture. We adopt a cloud-native microservices architecture with a clear separation between the front end and back end. On the far left is the AI computation engine, built with Python and Gymnasium, It is responsible for PPO inference, backtesting, and scheduling, and it outputs a 7-dimensional allocation weight vector. Next is the Fast API inference service, which supports both scheduled and real-time triggering. The results are then written into Redis through a publish-subscribe channel. After that, the Spring Boot API gateway handles REST reverse proxying and SSE broadcasting, while Kafka is used to decouple market data, feature, and logging services. On the far right is the React 18 War Room frontend. It is also worth noting that every data snapshot recalculates its SHA-256 hash in real time when loaded, ensuring reproducibility. For the asset allocation component, we divide the capital pool into 3 tiers based on risk characteristics. The offensive sector includes AI and semiconductor-related assets, such as NVIDIA, AMD, TSMC, and Micron. These assets serve as the return engine, taking on higher risk in exchange for potential excess returns. The defensive sector consists of gold, represented by GLD, and long-term U.S. Treasury bonds, represented by TLT. When the VIX rises or when the market structure breaks down, this sector absorbs capital withdrawn from the offensive sector. The third tier is cash. When a liquidity crisis occurs and equities, bonds, and gold decline simultaneously, the model can shift weights into cash to strictly control maximum drawdown. The allocation band shown at the bottom represents the daily weight vector output by the model. The 3 sectors always sum to 100%. There are 3 key specifications of the PPO model. First, the observation space is 63-dimensional. For each asset, we include 5 SMC features, along with price momentum, volatility, macroeconomic indicators such as the VIX Fear Index and the risk-free rate, DTB3, as well as the current portfolio weights. In the ablation study, this is reduced to 33 dimensions. Second, the action space is 7-dimensional. The output is transformed into a simplex through softmax. We adopt a long-only setting, and the maximum weight of a single asset is capped at 0.4 to avoid excessive concentration. Third, the reward function is the core design. It consists of log return, minus the drawdown penalty, and minus the turnover penalty. This reflects a risk-first design philosophy. For training, we use PPO from Stable Baselines 3 with a default 64 by 64 neural network. The model is trained for 500,000 steps with a fixed seed of 42, and the training process takes approximately 23 minutes on a T4 GPU. SMC feature quantification is the methodological core of this study. Traditional SMC relies heavily on the subjective judgment of traders. In our work, we systematize it into physical observations within the reinforcement learning environment, with each asset producing 5 continuous features. For market structure, when the price breaks above a previous high or below a previous low, we record BOS as trend continuation, or CHOACH as trend reversal, and convert them into discrete vectors of +1, 0, and -1. For the fair value gap, or FVG, we calculate the percentage distance between the current price and the nearest unfilled gap. For the order block, or OB, we record both the touch status of the institutional order block and its distance ratio. With these features, the model can avoid blindly chasing prices when institutions conduct liquidity hunts or false breakouts. Each feature column is defined by explicit decision rules, which satisfies the principle of interpretability. The final part of the third section is our War Room front end. It is an interactive dashboard built with React 18, TypeScript, and Vite. The dashboard presents the decision trajectory of the PPO agent in real time, based on historical data from 2018 to 2026. It includes a transition chart of asset allocation weights, the dynamics of portfolio net value and drawdown, and SMC markers overlaid on candlestick charts. The value of this interface is that traders and risk management personnel can continuously monitor the AI's decision logic and conduct risk reviews. This significantly improves trust in automated trading. Next, we move on to the fourth section, simulation, which covers the experiments and validation. Let us first introduce the experimental setup. The backtesting period covers 2,094 trading days from early 2018 to April 2026. This period is intentionally selected to include multiple market regimes, including the end of the 2018 rate hiking cycle, the COVID-19 market crash in 2020, the Fed rate hiking cycle in 2022, and the AI-driven market rally from 2023 to 2025. The action space is a 7-dimensional simplex consisting of 6 individual assets plus 1 cash bucket. The model is trained for 500,000 steps with a fixed seed of 42. The observation dimension is either 63 or 33, depending on whether SMC features are included. The risk-free rate is based on the 3-month Treasury bill rate from Fred. Reproducibility is especially emphasized in our experiment. Every data snapshot recalculates and verifies its hash when loaded. If the hash does not match, the process fails immediately. This ensures that the same policy combined with the same dataset will generate a byte-identical trajectory. This slide presents the main results, starting with the full in-sample backtest. The model achieves a final net value of 116.79 times, with cumulative returns exceeding 11,000%. The annualized return reaches 77.5%. The Sharpe ratio is 2.54, and the maximum drawdown is controlled at 16.2%. On the right, we compare our model with different benchmarks. PPO with SMC achieves 116.79 times, while the strongest single-asset buy-and-hold strategy, NVIDIA, reaches 42.46 times. The equal-weight rebalanced portfolio reaches approximately 14 times. In other words, our strategy is 2.75 times stronger than the best single-asset benchmark and 8.3 times stronger than the equal-weight strategy. This indicates that the model extracts significant alpha from cross-asset timing and allocation switching, rather than simply betting on NVIDIA. It should be noted that this table represents the in-sample backtest over the same period from 2018 to 2026. To verify that the performance shown earlier is not simply the result of in-sample overfitting, we conduct a strict time-split validation. We use data from 2018 to 2024 for training and use the completely unseen data from 2025 to 2026 for out-of-sample testing. The left side shows the in-sample results, while the right side shows the OOS results. There are 2 key observations. First, risk control remains stable across periods. The maximum drawdown in the OOS period is 15.73%, which is almost identical to the in-sample maximum drawdown of 15.54%. It is also the lowest among all strategies during the same period, significantly better than the 36.88% drawdown of the NVIDIA buy-and-hold strategy. This demonstrates that the model's risk control behavior is not accidental. Second, we also disclose the limitation honestly. The absolute return in the OOS period is lower than that of the equal weight and risk parity strategies. This is because the 2025 to 2026 period is a strong one-sided bull market, where heavily allocating to risk-on assets directly benefits performance. In contrast, our model retains defensive and cash positions due to the drawdown penalty. The decline in Sharpe ratio from 3.50 to 1.73 is therefore a normal phenomenon, but it remains significantly higher than NVIDIA's 0.71. Next, we conduct the SMC ablation study to quantify the contribution of SMC features from the observation space. The results are very clear. With SMC, the final net value reaches 116.79 times. Without SMC, it only reaches 18.66 times, resulting in a 6.26 times difference. This gap is far beyond the normal noise range of reinforcement learning training. More importantly, from the risk perspective, the maximum drawdown drops significantly from 40.9% to 16.2%, a reduction of nearly 25 percentage points. The Sharpe ratio also doubles from 1.23 to 2.54. This shows that SMC not only improves returns, but also substantially reduces risk, which directly supports our risk-first design intention. To be transparent, this is the result from a single seed, and multi-seed statistical testing is still in progress. This slide presents what we consider an important methodological contribution, the detection and correction of look-ahead bias. In the initial version, the model produced an abnormally high final net value of 2,350 times. Instead of directly accepting this result, we initiated an internal review. The root cause was that SMC swing points require the next L candlesticks to confirm, but the program updated the market structure state immediately at the current time step. This effectively leaked future information into the observation space. To fix this issue, we delayed the SMC features by L steps along the time axis when loading the observations. As a result, at time t, the model can only observe the features available at time t minus L. After this correction, the final net value returned to 116.79 times. In addition, the next-day correlation coefficient used to measure causality dropped below 0.07, confirming that the decisions no longer relied on future information. We also use the theoretical oracle upper bound as supporting evidence. The upper bound reaches as high as 10 to the 16th power times, while our result of approximately 117 times is far below it. This indicates that the result remains within a physically reasonable range. We suggest that all reinforcement learning studies in trading should include this correlation coefficient test as a standard sanity check.
Finally, we move on to the conclusion. To conclude, our core contributions can be summarized into 4 points. First, we are the first to quantify SMC structural features and integrate them into the observation state of PPO, filling the research gap between SMC and reinforcement learning. Second, the ablation study shows that SMC brings a 6.26 times improvement in final net value and an almost 25 percentage point reduction in maximum drawdown, improving both return and risk control at the same time. Third, we openly disclose the complete process of discovering, diagnosing, and correcting look-ahead bias. We also provide the oracle upper bound as a reproducible checking tool, which itself contributes to research transparency. Fourth, the microservices-based war room system brings decision transparency into practice, with enterprise-level stability and deployment capability. On the right side, we also honestly list the limitations and future work, including multi-seed statistical testing, walk-forward validation across multiple periods, more realistic transaction cost simulation, and a larger asset universe. This concludes our presentation. Thank you for listening, and we welcome any comments or suggestions from the professors and fellow students.